Welcome to our investment series where we're going to break down some jargon and some complexities from the investment industry, and we are going to distill some of these principles in practical examples. Please follow us for this series. I'm sure you're going to enjoy it. Good day, my name is Jan Botha, Wealth Manager at PSG Wealth R21. In my previous video, I briefly chatted about events that shook the market. Certain examples were given, the COVID period, 9/11, etc., etc. And a common mistake that investors are making is that they manage their portfolio from one event to the next. Today, what I would like to do is to distill you into our philosophy, how we see risk, how we perceive risk to be a consistent in your investment portfolio. The two risks that we plan for is inflation risk as well as volatility risk. Let's start with volatility risk. Volatility risk refers to adverse market movements if you have a short-term liquidity requirement. We typically see this when members of a pension fund might retire and they need to draw an income from the investment portfolio. So in the short term, we typically use 1 to 2 years. Volatility risk can have an adverse effect on your monthly draw. As time goes by, your volatility risk starts to decrease. So I'm not concerned if the market drops by 10% in 5 years from now. But if I earn a monthly income and the market drops today by 10%, I would be concerned. So that is the one risk that we need to manage. The other risk, which we easily underestimate, is the risk of inflation. I guess in your personal household, your personal inflation is probably 10% plus. And that is a guarantee. So we need to make sure that your capital can preserve its real value so that you can still buy the same basket of goods in 10, 20 years from now. Again, do not underestimate inflation risk in your portfolio. So we've got these two risks. So how do we manage it? In our world, to use terminology, we refer to as asset classes. The one asset class is cash, bonds, property, and equity, which can be local or offshore. Now, these two risks need to be aligned to the appropriate asset class. We know that cash will never outperform inflation. So if your risk is inflation, cash is actually a high risk investment. And the other way around. If I have a short-term liquidity need and I invest in the equity market, that would be a very high risk investment. So asset allocation is a function of how do I adequately allocate my capital to manage these two particular risks, and there's a fine balance towards that. At PSG, we would typically say if I draw an income from my investments, just keep 1 or 2 years of income aside. Then I know that if the market goes through turmoil, I am okay with my income. I would not be concerned. But if I'm going to live for another 10, 20 years, I know that I will keep the real value of my money because I've got a fair allocation towards equity. Let's sum this up. Two risks will always be with you. Inflation risk as well as volatility risk. All the other market events will always be there. But these two risks will be a constant and will have a direct impact in your financial well-being. Speak to your advisor to make sure that your investments are aligned to your personal risk profile. And that is where 90% of your investment success lies, is on adequate and appropriate asset allocation. For the last 16 years, I've been guiding investors and families on their financial journey. Two things that I'm really passionate about is the financial markets, but more importantly, is to navigate my clients through the storms and turmoils that these markets do present. If you need someone to navigate you through this financial journey, please do not hesitate to reach out to me.